buying a business, own your own business without starting it. Sponsored by Navan Capital Group. I work with Navan Capital Group. My name is Sam Obeid. I'm an entrepreneur, started businesses, bought businesses, sold businesses, and I figured a way for everyone to learn from the process of buying a business or selling a business that rather than starting from scratch, spending all the resources on starting a business with the enormous amount of risk that you will take when you start a business. So it's about the process of buying a business, which has an enormous amount of details. We're going to, it's more of an overview of the process rather than an in-depth discussion of any of the topics. Of course, everyone who's here is motivated for a reason, and there are different reasons why people buy a business. So why would you want to own your own business? Curious to know. Anybody has something to share? Be your own boss. Anybody has anything to share?
You dictate your own future.
Okay, so you ordain your destiny, which is very crucial. And there are other reasons, and I'm going to cite some of the most important reasons. 2/3 of millionaires in America are self-employed. When we say self-employed, that means they own their own businesses. And that business could be small or large, whether it's Facebook or a mom and pop shop store on the corner of Central and 159. Of course, it provides financial independence, security from the job market trend that we've seen in the past. There's tremendous amount of layoffs and unpredictability with the work force employment. So it could be a way for you to secure your own financial future. And another reason a lot of people cite is being your own boss. So you have a control over your financial future and your career future. There are different ways for you to own your own business, including the acquisition that we're contemplating here, and including starting a business, including intrapreneurship, which is a joint venture with an existing business, or franchise. Anybody contemplated a franchise? Franchise starting a business from scratch with some established systems, and you pay for that. We're going to compare mainly the startup process with the acquisition. How is the acquisition of a business compared to the startup of a business? We'll be comparing that and see the difference. These stats are at best mild in the way they evaluate the failure rate for startups. Several studies suggested that 3 out of 5 small businesses fail within the first year. 3 out of 5. So that would be, and 60% fail within the first year. I believe this is kind of mild, especially the second one, and it's an obsolete stat. New establishments show an average survival rate of 39, or about 40%, in their 6th year, after their 6th year. This is outdated. This was in 1970s and 80s, when the U.S. economy in my opinion, was at its peak. Business acquisition is a lot easier to finance. You walk into a bank and you say, I want a loan. They'll say, what's the loan for? You'll say, I'm starting a business. Well, as long as you're pre-revenue, the bank will say, most likely will say, well, let's see you again when you have revenue, when you have income actually, when you have EBITDA, you have profit. So if there's an existing business, you walk into a bank and they'll say, thank you for coming, let's see how we can help you get a loan to buy that business. Tons of advantages for buying a business. The main reasons, the main advantages are to start on day one with profit versus taking the risk with the burn of some of your savings to get to the profitability of the business that you start. So a business an existing business could be profitable from day one. And of course, it reduces the risk. There is a risk for business ownership, and there is a risk for business acquisition. However, it reduces the risk of making that business that you start a sustainable business. Reduces that tremendously. And of course, we mentioned financing options, which is very crucial, unless some of us have loaded with cash and you don't need financing, but most of us will need some sort of financing. And in order for us to grow, we can focus that financing on growth of the business, the acquisition and the growth of the business, rather than focusing it on starting and establishing the business, buying the equipment, buying the inventory, establishing credit with suppliers, and marketing our business, reaching out to clients. So all these reasons are, of course, it also increases your potential for success, because there's an enormous amount of resources, energy, time, and money that you put into the startup process. If you use that to grow the business, you're more likely to succeed in that process. So it does increase your success potential. You'll start with an established customer base. You'll have customers. Your customers already know about your business. The customers already have an image for your business that will help your business move forward. You have an established relationship with suppliers rather than contacting them and going through the process. You probably have also credit with those suppliers, which will help you finance the operations of your business. You have inventory already in place, so you don't have to go out to the suppliers and start ordering until you get orders. So you have accounts payable, accounts receivable. You have all these in place, so you have income coming in, and you have receivables paid in every day. Of course, it may continue to be successful, and you have processes in place. This is very crucial. You have processes in place. One of the things that hold entrepreneurs is the processes, establishing processes, because entrepreneurs are usually hands-on people. They work on the business, start it, and they know how things are done, but they cannot put it on paper. They cannot put it in writing. So most businesses have established processes for hiring, firing, credit, providing credit to clients, or how you pay your suppliers. There are processes that you follow. When the business has those processes established, it's a lot easier for you to improve them than to spend your energy and focus on establishing those processes. You have control systems, so you know when things are going to be paid. You have when the checks will be deposited into the bank account, how invoices are paid. You have control over that. It's a bargain, and I'll show you why it's a bargain. When you buy a business, it's a bargain. We'll have several slides on the return on investment that you can achieve when you buy a business. There are two scenarios that we're going to discuss. Whether you buy it in cash, you pay for it cash up front, or you finance it, which we call leverage in our industry. Now, if you're convinced that buying a business is the step for you to take, then which business would you buy? There's a huge gamut of businesses that are for sale. And there are businesses that are not listed for sale, but they could be for sale. So you want to focus where your selection would be. And to select the proper business for you, could be the best is to do some soul searching, to go back and review your skills, interests, education, and background, your past careers, and see how all these, that mix will help you succeed in a business. So you select a business based on those factors: education, past career history, interest is very crucial. You want to buy a business that you have interest in. You want a business that you love, so you can persevere in the face of storms. Of course, you want to know about your skills, your abilities, and another factor which is crucial, you want to know what's hot in the market. What are the businesses that are really blossoming in the market? What industry is declining or plateauing? What industry is growing in the growth mode? What industry is in the decline mode? Which ones are flat? Some industries go into the bell-shaped curve very fast. Some of them go very, very an extended period of time. They go over through an extended period of time, especially basic businesses, furniture, this is basic business. There are technology companies that go real high and then they decline. For example, Microsoft now, it used to be the largest US company on the stock market. It's now fighting to be relevant in competition with Apple and with Google and with other technology companies, Amazon. So it's fighting to be relevant. At one point, it was the largest company in the U.S., the most capitalized company. So you look into your background and the puzzle, the mix of your experience, background, interests, preferences, what you like to do, what you see yourself doing. All of that will help you determine what kind of business you can buy. Now you would say, if business ownership is that good, why would anyone sell? So why would the seller sell their business if it's that profitable? There are life events that happen to a business owner that will dictate the sale. And unfortunately that happens to many of our clients. For example, health issues or death. I have a client that is selling due to death in the family. And they're unable to manage the business after the owner passed away. Health issues could dictate the sale of a business. If the health of an owner declines, then they want either to have a partner, which what we call reorganization or recapitalization, so they sell a portion of the business, or they sell the business and they continue consulting role with the business. The gentleman here suggested relocation to the south. So that could be another reason business owner, relocation could be a reason why business owners sell their businesses. They have family in a different city, they relocate, and the business is not relocated. There are businesses that you can relocate, you can take them anywhere you want. And there are businesses that are location dependent. Those cannot be relocated without losing the clientele. Retirement is usually a factor for business owners to sell their businesses. Most of the time it's significant. These are factors that are not sort of based on their importance. I'll show you in the next slide factors that played a role in the sale of the business based on how often they were cited by business owners as the reason for them to sell. There's boredom, burnout. If you started a business 20 years ago, for God's sake, you want to start something new. You want to change pace and do something completely new. Competitive pressure, whether it's from external pressures, whether it's from competitors, competitive pressure. Some industries are consolidating and there are bigger players that pressure the owner to sell, and they're approaching retirement age, so their energy level is not what you can provide into the business and grow it. So there's competitive pressures, there's suppliers pressures, there is client pressures that could be exerted on the business. Financial diversification. If you buy a publicly traded stock, typically it's very liquid. You can sell it on the same day. A privately held company is a lot less liquid. Typically, a sales cycle for us to sell a company marketed for our sellers takes 6, 9, and 12 months. On average, it takes 9 months. So it's an extended period of time for someone to come and step in and say, I can take that company and buy it. So the liquidity and financial diversification, which come hand in hand, So business owners, as they age, they want to change their financial position from something illiquid, like a privately held company or a business, into something more liquid, like CD as they retire. It's more guaranteed income, it's less rewarding, but it could work for them. So some business owners, that could be a reason for business owners to sell their businesses. The need of growth capital. One of my clients now has a phenomenal company. It's been in business since 2003, and it sells to some of its competitors. Has very good reputation. The owner has limited access to capital, so he is looking for either a partner or someone to buy the company with access to more capital so they can grow it and take it to where he projected it to be. We mentioned liquidity. Here are some of the factors. I hope you can see them all. Some of the factors that business owners cited. Now I want to bring your attention to the fact that they add to more than 100%, and that is because some of them are cited more than once. So, 44% of the time, reducing risk to personal assets, which what we mentioned. You want to have your net worth in more liquid and less risky investment. Was cited 44% by business owners, and 41% of the business owners cited market competition as a reason for them to sell their businesses, and 27% cited market pressures, whether it's from the suppliers, the buyers. There's ongoing demand from us, from the buyers, from consumers, to have a lower priced commodities and products. And that's why we search on eBay and Amazon to see if the price is better than Walmart, and we buy from there. So we're exerting the pressure on Walmart and Amazon and eBay to lower their prices. So that could be considered a buyer or client pressure. There's also supplier pressures. Some industries where you buy from suppliers, they raise their prices, and if you're smaller, they make their credit terms shorter, so you have to pay faster. And there are lifestyle, whether age, retirement, or health, or other factors. We're cited about 14%. Lack of capital, which we mentioned, was cited about 9%. And the management issues, concern managing employees. Managing a small business could be a challenging job to do, and it requires energy. And the owner is in their 60s, so it could be challenging for them to manage. While a younger person could manage the business with more energy, with more creative ideas that will help the business grow. And other factors were cited 6%. Now, if you decided that, okay, acquisition of a business is for me, and I know what kind of business I want. So how do you find businesses for sale? How would you find a business for sale? Of course, there is business intermediaries, mergers and acquisitions advisors or brokers that work on some of their businesses. Typically, most intermediaries or brokers represent the seller, most of them. There are some of them that represent the buyer. So you can approach one and say, okay, I'm looking for a business, and you sign an agreement that if you buy a business, then there's a success fee involved with that business intermediary. Most businesses, however, are sold in an agreement, what we call the sell side. So the intermediary, the broker, is working with the seller. You can also have a campaign to contact business owners who own this kind of business, the business you decided, in the area, in the geography where you want, in the size you decided, because you have a certain amount of investment, you can pre-qualify for a loan, if that's your route. See how big your investment can be, and see what kind of business you can afford. You decided the industry, you decide the size, and you decide the geography, and based on that, you can have you can either search for available businesses for sale, as we mentioned with business brokers, or for sale by the business owners, which is a minority. Just like in the housing market, there is a lot more houses sold by realtors than by owners. Same thing with businesses. There are some businesses for sale by owners. The sale of, as we mentioned, it takes 6 to 12 months, and it's a very challenging process to entertain the buyers while you're entertaining your customers. So that's why you will see very few businesses sold for sale by the owner without a broker. And you can have a campaign. You can call and have a list. For example, in the library here, I think there are databases of businesses, Reference USA, or one on Brad Street. There is a $1 million database. You can search for the businesses that meet your criteria and contact them, or mail them, or email them. And you can also, if you decided the industry you want to search in, you can place a business wanted ad in one of the trade publications of that industry, or in any business section of a newspaper where you decided the geography. You can also spread the word to family and friends. And it's going to take a lot of patience. The business buying process is a complex process. It's worth it. It's rewarding. And I'll show you in a few slides why it's worth it, why it's a bargain, why it's rewarding. Now, if you decided, when you find business, when you see the businesses, you want to learn how to evaluate those businesses. Obviously, the financials are very crucial. And the way we do our taxes is we try to minimize the bottom line. So we're going to talk about another aspect of the financials, how you evaluate it, how you look at it, what are the crucial numbers for your decision. You also look if the business has been intensely marketed. That means the market could be exploited, and there is very limited room for growth. You want to look for a business that was minorly marketed or not marketed at all, which is the situation of many of my clients. They do very minimal marketing. So if you do marketing, you can own the upside of that. You want to look at the owner. How involved is the owner with the business? Is he involved 80 hours a week, or is he involved 30 hours a week? You want to look at that. You want to make sure that you can manage that, or if you need to hire someone, you account for that. You want to look at competitors. How does the business compare to its competitors? What differentiates it from its competitors? Is there any value added that the business has, value-added features that the business has that will make it better than the competitors? Or what makes the competitors better? So we want to make sure that you do that comparison. The scalability, which is, in my opinion, is a very crucial factor. You want a business that you can grow beyond the limitations that it's at. For example, if you see how Facebook started with one person designing a web page with some code growing into a multi-billion-dollar company. That is very scalable model, very scalable company. You can grow it from very small to very large with very, very few resources. While, let's say, if you open a restaurant on the corner of the streets, it'll be a lot more challenging for you to open another one. So the scalability is more limited for brick and mortar businesses. So when the business is more scalable, you can grow it with the same resources that you have. It's obviously worth more. And the tenure of the business, how long it's been in business, how long has the owner operated it, and if there is a previous owner to that owner, how long they've had it for. So the longer the tenure, the history of the business, the better. The more indication that you get that this business will continue to be successful. So if you decided with those factors that you evaluate a business, you decided on a business. This is the business. I found the business that I want. How do I finance it? Of course, there is commercial finance, commercial lending. You can always go. Any business that has cash flow will qualify for some sort of financing. The difference with the SBA guaranteed loans are 75%, up to 75% guaranteed by the SBA. So if let's say a business collapses and the owner defaults on the loan, the bank still gets their 75% from the SBA. It's like PMI insurance for the house. When you buy a house, there's PMI insurance you pay if your down payment is less than 20%, because the 80% is guaranteed by Freddie Mac and Fannie Mae. So the SBA guarantees 75% of your loan. So if you default, which encourages banks to give those loans. Of course, there is a process that banks go through to approve those loans, and sometimes it could be challenging, but it's worth it, and I'll show you why. And there is also another sweetener to the deal, which is the seller financing. Most deals in today's market go with seller financing. And seller financing is the sweetest thing on earth, because typically the seller will accept a lower interest rate because they know they cannot get the interest rate, and they consider it, an incentive for you to buy the business. So it's always a good deal when you have seller financing.
Quick question, for seller financing, is it also under creative financing whereby instead of giving you the upfront cap or the upfront total monthly capital, you give them proceeds or percentage of proceeds of revenue for X amount of time in the future?
Right.
Is that another option as well?
It is.
Okay.
That's seller financing. I will discuss a scenario where it involves seller financing and certain interest rate. We'll discuss it when we evaluate the return on investment when you buy a business. There is also microlenders that will give you up to $50,000 loan. So you can use that loan to buy the business. You can reach to your family and friends and partner with them to buy the business. You can, there's also lines of credit, whether it's home equity line of credit or other kinds of lines of credit. You can use those to buy the business. You can also, if you've been in corporate America, you have a good IRA account or 401k, you can use those, tap into them, and use them to buy the business. There are companies that will help you use those funds to buy your business. There are restrictions, but it's worth it to tap into them. Investors are obviously a good source of financing. There's also other assets that you can use, other ways to finance the business acquisition, including the business assets. You can, as you can see here, there is a sale and leaseback at the end, and there's business assets. The business is in manufacturing and has a lot of equipment that are free and clear by the owner, by the business. What you can do is sell them to a sale leaseback company and lease them back from that company. So you free up that capital that is reserved in those assets. You can free it to use it to pay for the business, and you pay from the cash flow. That's a sweet deal too. Business contracts. Let's say the business has solid contracts with the federal government or with IBM. Then those contracts could be financed before they're paid, before they're into your cash flow. They could be financed. Today, they're more challenging. I had several clients that needed that kind of financing, but it could be done. There's business customers. You give the customers of the business an incentive to prepay for the services that usually they ordered for a discount. But you can use that money you raise to buy the business, to put it down. There's suppliers' lines of credit. Lines of credit. Let's say your suppliers give you 15 days to pay your bills. You can negotiate with them to make it 45, for example, or to lower the interest rate if it's late. You can also reach out to partners, as we mentioned. We mentioned the sale and leaseback of business assets. I'm going to start discussing with you the scenario. We had a business. The advantages to SBA loan. Some of the advantages here, we mentioned that when you approach a bank, there are options for you, including the SBA. And some of the advantages to go through the SBA route, in spite of the what's known about it's a lengthy process and paperwork. Obviously, it extends the term of the loan, which gives you an advantage because your cash flow becomes better, your bottom line stays better. Because when you're paying a loan, you're taking it from the cash flow and paying it into the loan. When the term is longer, the payments are smaller, so your cash flow is better. If you have a loan, SBA loan for working capital, which is to pay your accounts payable, for example, or a line of credit, or to buy furniture, fixture, and equipment, or to buy inventory, then your loan could be up to 7 years term. So you could finance it, amortize it over 7 years. If it's for business acquisition, if you're buying a business, you can finance it up to 10 years with that 7A loan. And then if there is real estate involved, then it becomes 25 years, which is a sweetener. And the good thing, if your loan term is less than 15, there is no prepayment penalty. And there is no balloons with the SBA. The SBA doesn't allow for balloons. They want more predictable loans so you can work it with your cash flow. If there is a shortfall in the collateral, so most other commercial loans, not all of them, but most of them will require you to have collateral for your loan. So you pledge your assets, you pledge your house to cover as a security for that loan. The SBA provides financing if that collateral is short of your needs. Because remember, it was guaranteed up to 75% by the SBA, so if it defaults, the bank gets their 75%. And that's why they require you to have 25% down, which we'll discuss. And of course, it requires no down payment, especially if there is seller financing that you combine with the SBA loan. And there is no banking covenants. There is typically personal guarantee that you guarantee the loan. Let's look into a scenario of a business that has been for sale or sold, and the selling price was $365,000. The annual revenue was about $720,000. And the seller discretionary earnings have been SBE. We'll discuss the SBE in a moment once we discuss recasting the financials. And the business operated for 16 years. The last 9 of them were with the present owner. And the owner is retiring. He's reaching retirement age. And the owner was willing to finance to the buyer to hold the loan at 6% up to 25% for 5 years. And it's free from any legal judgment or settlement, financial debt. So it has no debt.
I'm sorry, annual returns means top line revenue area.
Revenue.
Okay.
Oh, that's a typo.
Okay.
Yeah, it's a typo. Revenue. Yeah. Okay. Here is how it was acquired. The sale price, the purchase price was $365,000, and working capital, which what you need to inject into the business until you get paid from the business, was about $10,000 because it goes into accounts receivable, and it takes a while for those accounts receivable, probably most likely 30 days, for them to convert into cash. So you need some money to pay your employees, to pay your suppliers, while the money is coming. So he needed $10,000. And there's some professional fees, legal and accounting, that he needed to do. The buyers drafted the purchase agreement. His attorney reviewed it, and his accountant provided, financial documents to the buyer. So that cost him about $5,000. So the total project cost was about $380,000. And the seller provided 20% loan at 5% or at 6% for 5 years. I've seen deals where the seller note was at 4% and even longer years. And here's the sweetener. When the seller provides a note, the SBA, in order for it to count towards the down payment, you're required to put down 25%. In order for that seller note to qualify, then it needs to be a 2-year standby, which means there is no payment until the second anniversary.
I'm sorry, so for the seller financing, would that be taken into account as your down payment to the SBA?
So in order for it to count, it needs to be a standby note for 2 years, which means
Has to be
you start paying, right.
Has to be valid for 2 years, so you can't.
You're right.
Okay.
The SBA want to make sure that you have enough cash flow to cover your growth needs. And then the 10% down payment. So the buyer paid $37,000 to buy the business. So the loan amount was about $270,000.
I'm sorry, for the 10% down, it's $37,000. Where do you get that 10% from? I mean, if the total project cost is $380,000, 10% would be $38,000, so $37,000.
Right, it should be 38. Right.
Okay. And it,
But
okay.
it makes no difference.
Okay.
The working capital could also be financed. I just want you to know that, which makes your needs for the down payment smaller. Okay, now we talked about seller discretionary cash flow, which is what you really look at when you're evaluating the business. When we do the taxes, when the business owner does the taxes, we do everything possible, legal and ethical, to minimize the bottom line, which is the profit the business is generating. So we add all kinds of expenses that their purpose is to lower the tax burden, the tax liability of the owner. What we do here with recasting the financials, we take those back and add them to the profit to reflect the true profit of the business. Because if you're getting your car payment from the business and you're deducting that as an expense, then it's actually something of the benefits you're getting as a buyer, as the owner. And if you buy the business, you'll get the same benefits. So adding those is called recasting the financial statements, the income statements. And when we recast them, we add those expenses back with, we replace the numbers with ones that reflect the future when you own the business. And we come up with the seller discretionary cash flow, which is the EBITDA, right, or profit, plus all those, the EBITDA plus those expenses that we added back. Which means the expenses that we typically add back are the owner-related expenses, car, phone. All these are benefits to the owner, so we add them back there to reflect the true cash flow of the business. And excess family personnel. Let's say there is a person who is on a personnel getting paid on the payroll without showing to the business, which happens, or overpaid. You know, they come and do 10 hours a week and they're paid for 40. They're overpaid. So we add those back. We add the difference to reflect the market need, what the market dictates the business pays for those employees. And we add non-recurring bad debt. If there was a storm and then the business flooded, there was some certain expense that we don't expect it to happen every time. So we add that back. I'm just giving an example. Non-recurring income and expense. Just like we add back non-recurring expenses, and we remove the non-recurring income. The income that happened only once. We don't expect it's going to happen again. So we also remove it. And that's why it's a fair process. It's the process that we should do to truly reflect the value of the business, the profitability. Discretionary professional fees. Let's say the owner can afford to pay the account of $1,500 a year, and he chose to pay $5,000. So that's completely discretionary. He can go with the $1,500. Or he opted to bring a consultant into the business to improve the business, but he doesn't have to. Or extraordinary expenses. We add all these back. The cash flow for that business, the profit, the scenario that we talked about, is $75,000. So on the tax return, they're paying tax on $75,000. However, there is depreciation. Depreciation is a non-cash expense. Let's say, I'll give you an example. The business makes 100,000, and depreciation was 13,000, just like ours. Just giving easier numbers. Then, what you end up in the bank account at the end of the year, if you didn't take anything else, if you kept it the same, you end up with 113,000. Not just 100, because depreciation is not a cash expense. It is a way for us, for the IRS, to give you tax deduction for your investments in equipment, products, real estate, inventory. So when you depreciate it, you deduct it as an expense, but it really is not an expense. And then there is interest. If the owner has loans for their benefit, when you buy the business, we usually evaluate it without those loans because we assume loan-free, debt-free business. Because you're going to pay him off, or he's going to pay him off when you buy the business. There is also salary. Typically, the owner is required. If it's a C corporation, the owner is required to take a salary. If it's an S corp, then it's okay without taking a salary. But most owners do take a salary. The owner in this case is taking about $44,000. So their total is about $146,000. Any questions about it? Wow, that means I have the smart move. Okay, now, the return on investment. If you pay cash for that business, of course, the return on investment is what you put into it, divided by, what you get out of it, divided by what you put into it. So 100 times net cash flow, that's the annual return, because that's what you're getting every year, divided by the down payment, which is the whole price, which is $380. So 100 times 146, which is the discretionary cash flow, divided by 380 is 38%. Now, raise your hand if you know of an investment that will give you a better return. And we're not done yet. Let me show you. Let me show you what really it's a bargain. If you finance it, if you finance the business acquisition, the cash flow is 146. And you're paying the SBA loan, like our buyer, $36,378.72 a year. That's your annual debt service. And if you're paying the seller $16,531.20. And your cash flow after debt service, so if we deduct that from the 146 to get the true cash flow that you're receiving, is $93,090.08. And your down payment is $37,000. So 100 times net cash flow of $93,000 divided by $37,000, as you see here. And that gives you 251%. 251%. And that's why it's a bargain. That's why I will go with it every day versus buying a business or starting a business from scratch. And we actually omitted some of the equity build up. When you're paying the SBA, there is some equity built up. So some of it is principal paid back. We ignored that for simplicity.
Quick question, why don't you factor in the, under down payment, they have $37,000, why don't you, because that's only considered your SBA debt, why don't you factor in the actual debt they owe to the previous owner as your calculation for ROI?
Because that's the owner's debt. And when the owner gets the receipts of the sale, they have the choice either continue paying those debts, which is a limited option, but usually they pay them off. Usually the owner pays these debts off. So in other words, when you're buying the business, you're buying it debt-free. So the debt is the owner's issue. Whether they want to continue to pay it off installments, if the bank agrees to it, or if the buyer assumes it, which is another alternative, could be an alternative to the seller financing, where you assume the debt of the business. I have a client now where the buyer is assuming most of the purchase price or most of the purchase price is paid in the debt that the business owes. So the buyer can assume it, and then in that case, instead of the SBA loan, we have the debt service payment for that loan. Does that make sense? The acquisition of a business, as I mentioned, is a complex process. There are several steps, and in the sales cycle of an owner, it takes probably 6 to 9 to 12 months. On average, it takes 9 months to sell a business. So on the buyer's side, it's also an intensive process, extended process, that will take a significant amount of time and commitment. It's, as you see from the numbers, it's well worth it. So I would do it every day. It goes from learning about the business all the way to closing, and the steps in between. When you learn about a business, typically when there is a house for sale, the realtor will have an open house. So the information, the knowledge that this house is for sale is public. In other words, while when you sell on a business, it's the opposite. Usually when the business is for sale, we provide the information for the buyer to make a decision without knowing the identity of the business. Until we have the buyer sign a non-disclosure agreement where they promise to keep the information confidential. We provide them with the confidential information on those bases. So confidentiality is very important. So the first one, when you inquire about a business, typically you won't be signing a non-disclosure agreement. So you promise to maintain that information in confidence. And then you move on to the next step. You say, well, I sign a non-disclosure agreement. The business will send you a package of information on the business. So you learn about it enough to be able to make a decision. The package of information is typically, we call it offer memorandum. Some other practitioners call it CBR, Confidential Business Review, or other names. We call it offer memorandum. Let's use that name. So once you receive the offer memorandum, you review it. You say, okay, this is the business I want. I have some questions about it, however. So you reach out to the owner. You say, I have those questions on the business that were not answered in the offer memorandum. I want answers to them. So typically you get answers to them, and if you still think the business is the business you want, you go into the next process. You have a conference with the owner. We either do a phone conference, in-person conference, or both. So you learn about the business, you ask the questions, you meet with the owner, you know that there is chemistry between you and the owner. You prepare all of that, and then the step for you to move forward is the letter of intent, which is a contingent offer with a lot of assumptions. You're assuming that what the owner told you is true. So when you submit the letter of intent, you assume that is true. You don't say it's true, but you assume it's true. So when once your letter of intent, let's say you submit an offer on the business, and the owner accepts it, then that letter of intent will entitle you to start the due diligence process. The due diligence process is verifying what the owner said is true, which has several steps. We'll talk about it. And once you finish your due diligence process, which could be an intense process, you want to learn about the business, about the owner, about customers, about competitors, about suppliers, about clients. You want to know about the financials, the financial history of the business. There's a lot to it. But we typically have it in 3 categories that we'll discuss. So once you do the due diligence, you decide, well, this is the business I want. This really meets my expectation that were set through the offer memorandum. Okay, then you move to the definitive purchase agreement, where you reach out to your attorney, say, Mr. Attorney, I decided to buy a business. Here is the information I have. I would like you to draft a purchase agreement pursuant to the letter of intent that we discussed. So put this letter of intent into the details, into the purchase agreement, and let's schedule a closing date where I will be buying it, and I will, where I buy it, and our titles exchange, our exchange, and our money is exchanged. So that is the process, and then you start your transition period. You have a transition period where it's transitioning from the owner to you. You'll start operating it, working with the employees, working with the suppliers, working with the community of the business. Again, there are several steps in the process. If you have any questions on any of them, we'll discuss some of them in more details. Not all of them, but we'll discuss some of them in more details. But if you have questions, you can go ahead. Now, why is confidentiality important? Typically, when there is a sale of a business, we want that information to be confidential. The owner, at this stage, you want the information to be confidential. When you buy the business, you become the owner, you all of a sudden want the information to be confidential. So the confidentiality is two-way street between you and the seller, two-way. So after the sale, you want the information to be confidential. Because it becomes you want to protect your stake. And here is why it's important. The business is part of a community, or there's a community to it, whether it's employees, customers, suppliers, or competitors. All of them. This is a community to work with. So if they know the business is for sale, employees will think that they will not have a job, so they start looking for a job somewhere else. Suppliers will think that they will also need to replace that business. And the same thing with client. They will say, well, I can't buy this because I don't think the business will be here for me to service my product that I bought, or for a warranty issue. So all of them will start looking for something else. Even though the business is perfectly fine, the seller plans to keep all employees because the buyer plans to keep all employees, and the buyer needs all employees. The buyer needs the suppliers. So all of them will be in place. However, just the rumor will make the business look like it's in trouble, and everyone will start looking for an alternative. So confidential. That's why confidentiality is very crucial. When you become the owner, you want the information the seller knows to be confidential too, which most confidentiality agreements are two-way street. When you decided you're comfortable with the business, you really want to own it, you submitted the offer. The offer is called letter of intent. As we mentioned, a letter of intent is a contingent offer, assuming the owner's representations are true. So it's very contingent on that assumption. It could also be contingent on financing. If you need financing for the acquisition, then the letter of intent could be also contingent on financing. It could be contingent on relationship with the suppliers to be transferred to the new owner. So there are other things, other factors for the letter of intent to be contingent on. So once that process is accepted, there is typically a discussion between the owner and the buyer. And this is the price, these are the terms, this is what I'm willing to pay, this is what the owner is accepting. There is a discussion until it reaches where both of them accept it, and they accept the letter of intent. And I want you to know that terms could be as important as the price. So if you were paying over 15 years, it's probably better than paying a smaller price. So it could be equivalent to the price. Another example, if the seller is planning to continue working for the business for a year, that has a significant value. It makes the transition smooth. It also will help you save on the labor that the owner is replacing. Due diligence is, again, the process of verifying the assumptions that you made in the letter of intent. And ensure that all the seller's representations are true. That's what the due diligence is for. And it falls into several categories. The most important of which would be the financial, where you look into the financial history of the business and the financial records, make sure that they jive in. You want to make sure that the tax return reflects the income statement, and it also is coherent with, congruent with bank statements. So you want the money coming in to reflect those numbers, to be consistent. I'll just give you examples. There's vouching, you vouch the income that you're receiving and trace the expenses. These are the technical terms that are used in the field. There's vouching and tracing, so you make sure all the expenses are legitimate, all the income is legitimate and actually received. So there's a lot to it. Usually, if you're a buyer, a CPA will help you with this. And I always recommend to hire a CPA. They'll pay for themselves. There's legal due diligence, whether you have agreements with the suppliers, agreements with the buyer, with the clients, agreements, non-compete agreements, confidentiality agreements. You want to understand all of these, the commitments that business has made. And if the business has any legal judgment against it, or settlement, or there's any imminent legal threat, you want to know about it. That's the legal due diligence. And there is a business due diligence. You want to know about the industry. Where is the industry heading? What's the position of that business in the industry? Where is the business heading relevant to the industry? How is the business comparable to the competitors? How is the relationship between the business and the suppliers? How is it with the employees? How is it retaining the talent? How competitive is it in retaining the talent? So you want to learn about these aspects. And their business valuation. So how would you submit an offer without knowing the value? You want to know the value of that business. You want to know how much is this business worth? And how do you know that? This is one of the biggest questions in the business acquisition process. The biggest questions. We mentioned we recast the financials to come up with the discounted cash flow. The discretionary cash flow. There's a discounted cash flow, which is a way for us to look into these, the income we receive in 5 years, and see what is it really worth today. So if I'm receiving $100,000 in 5 years, what is it really worth today? That's called discounted cash flow. Again, it's a complex process. It's probably one of the best ways to value a business. It's a complex process, so just mention it and move forward. Our focus is on discretionary cash flow versus the net profit of the business. The discretionary cash flow versus the net profit of the business. There are 3 approaches for valuing a business. There is the cost, or any asset for that matter. There is the cost approach. How much did it cost to start that business? What are the resources taken to get that business up to where it is? So that's the cost approach. How much did the car cost? Cost approach. How much did the house cost? Cost approach to valuing it. There is also market approach. What are the comparable houses that sold for? What is their price range? So that's a comp approach, market approach. You compare it to other opportunities that are comparable opportunities sold for. You do the same thing for the business. And obviously you probably guessed it by now that the earning approach, the income this business is going to generate for you is the most important way, or the most relevant or effective way to value a business.
I remember reading about a place in southern Illinois that was for sale, and it was losing $300,000 a year. It was like a
So how would you value that?
Yeah, how would you value it?
There are-
Other than just capital assets.
That's why there are multiple ways to value the business. You want to know why is it losing first.
Mhm.
There's a story to the loss. Why is it losing money? If the loss is preventable, something you can step in and prevent it, reverse it, which is called turnaround situation, then there is value to that business, even though it's losing money. However, there is also the assets of the business that are worth something, whether liquidated or put together in a business. So these are different ways to approach the assets. And there's also a market approach to that business. But mainly for businesses that are losing money, we call them turnaround situation, there is assets involved, whether from goodwill, which is the reputation of the business, all the way to furniture, fixture, and equipment. So there's assets involved. That would be the bottom line for that pricing. But typically, we're talking about the average case scenario, the most frequently case or cited case where the business is profitable, so the valuation is based on the earning approach. And the equipment, which is the balance sheet, the cost approach, is reflected into it. It's factored into it. I'm going to focus on the earning approach. There is the asset approach and the cost approach. There are, you can, if you have questions about them, we can talk about them. But the earning approach, which is the most crucial, is dependent on recasting the net income, the net profit, into the true cash flow, discretionary cash flow. So the most important thing is the discretionary cash flow. So it's very dependent on that. The EBITDA, which is the net profit, is less important in that case. So typically, when you receive the information on the business, the financial history, we'll be recasting those financials to reflect the SBC. So the income statement is where we recast the income statement to reflect the discretionary cash flow. And there is also factors in the balance sheet. The balance sheet contains the assets and liabilities of the business. So that could be a factor, as you mentioned, business is losing money. So it falls back to the balance sheet in terms of valuation. So in a nutshell, how would you value a business? I want to make income and a compensation for running that business, along with the payments that I need to make on the business, all from the cash flow. That's the bottom line. That's what the minimum that you're looking for. And it's important to make sure that you have a solid understanding of the value of the business, because the biggest challenge for you is that you overpay. That's the biggest risk for you when you buy the business.